is a hanging man is a potential bearish reversal candlestick candlestick pattern. You know, it's a single potential reversal candlestick pattern that happens at the top of an uptrend, towards the top of an uptrend. This happened towards the top of an uptrend. So if you've been seeing the price action going up for so long, again, remember I told you guys the color of this doesn't really matter, but when a hammer is green, it's usually the best. When a hanging man is red, it's usually the best. Or when a shooting star is red, it's usually the best. But the color doesn't really matter, but the position does matter. So these two happen towards the top of an uptrend, signifying a potential reversal in trend, and these two happen towards the bottom of a downtrend, signifying a potential reversal in trend. So to me, or generally, the color of this doesn't really matter, but where it happens matters a lot for you to actually know where you are in the market and try to use some other factors and make good decisions for yourself. So yeah, like we were saying, Clovis, all of this is just the opposite of this. Same as I was saying about three white soldiers. The opposite of those three white soldiers, remember I said something about a reversal. Opposite of those three white soldiers is three black crowds, which happens again towards the top of an uptrend, or after an uptrend there's a consolidation, and then you start seeing instead of this you start seeing something like this going down. 3 ones is actually telling you that okay, maybe there's a potential reversal. So all of this stuff we've been jotting out, like Clovis said, just get that it's a full, the reverse is true for all this. And yes, the positioning or where it happens really matters a lot. Clovis, did I get all your doubts clear at all?
Yeah, you did, bro. Thanks.
Okay.
Yeah.
So do we have any other question before we head to the chart? I saw was Bless hands up. Bless, I don't know if your hand was up, you unmute yourself and ask your question, but if not, we head to the chart and identify some of those patterns.
Yes, my question is that when you see this engulfing candles, the bullish engulfing candles, the shooting star, the hammer, are you just supposed to jump into the trade, or you have to wait for something, maybe like a retest or something? I don't know. Because you say these are reversal candles, shows that when you see these signs, means the trend is about to change.
All right, like I was saying, as I've been explaining again, and I will say again, you don't really need to trade this by themselves. You don't really need to trade this by themselves. But if you want to trade this by themselves, yes. When you see a bearish engulfing candle, again, remember, it all depends where you find this at. Find this at the top of a trend. Yes, you jump, if you want to trade that just by itself, you jump into that short, right? Either you wait for the next candle to have a little bit make a high, and then you enter on the height of that candle, or you jump exactly as after this candle closes. Because the next one, again, I told you guys, the formation of the next candle likely depends on the closure of the previous candle. So there's a high probability that the next candle forming here is going to be red due to the closure of this, right? Because you have your change of market structure there. You have your change of market, you have your change of character right there. This one closes above the low of this, right? This candle open here and it make a low, and then it make a high, ended up closing there. But this one open here, make a high, ended up closing below that. So this is telling you that okay, there's been a change in market structure. So yes, if you're trading this just by itself, you enter right there, stop there, your invalidation is there. Given whatever risk reward ratio you're using, you measure your target towards maybe support line where the next support is down, or if you're using this, you probably enter your target where the next resistance is. Or again, like I said, you have to use 1 or 2 to 3 more confluence to get a better entry and a better target. So yes, if you want to trade all this single-handedly, yes, you can trade them after you've confirmed them. Just market, trade them, or you wait for a little bit of a pullback for your good risk reward ratio. Don't know what you're trading, but yes, you if you want to trade them by themselves, you do that. Did was your question answer, Bless?
Yeah, I think for now, I will do this explanation. Thank you.
Okay, you're welcome. Clovis, is your hand still up, or is it from a previous time?
It's from the previous, but since you spoke of risk reward, I just want like to get a quick clarification. So obviously you will not use just one of these confluences. Like maybe you will use three, or the more of them you see, the higher your confidence in that market move. So
Yes.
with that being said, would you say if you are confident, what should your risk to reward look like? Obviously, you would backtest a lot to see like which one occurs the most. Maybe it's two, maybe it's three, 1:3, 1:4, 1:2, depending on what you see. But so far, since you're experienced and you've been in the game so far for so long, what would you say is like the most reoccurring risk to reward? If you are scalping, let me mention this as well. If you are scalping, like one
So
is to two, three,
again,
which one?
yeah, go ahead.
So if you are scalping, when you are scalping, you said you do scalp sometimes. So when you are scalping, like what is your risk to reward ratio on an average basis look like?
Two. Always a
Two.
two. But the most one that you see most of the time is 1.5 arrow, but my own is always two. Sometimes I'll end up losing some trades that I was more than 1.5 arrow just because I don't trade that. I will not take that trade out. I want at least a two. If I'm losing one, let me make at least two times that. But most of the time on a daily scalping, you see at least a 1.5 arrow on a daily basis for scalping. But yeah, it always happen. But like I was saying, you definitely need to use a little bit more of different strategies when using as one of these. What I'm saying is you don't really need to say you're waiting to see all of them in a different price action. Sometimes just this thing happening in the south, right? You could argue that there will be three strategy there. If for example there is an engulfing candle right here, right? There's an engulfing candle, there's a green candle right here, right? This become at least a three confluences that you're using. If let's say put a green candle right here, this become a three confluences that you're using, saying that okay, you have your three stars in the south, you have your hammer, you have your engulfing, that is, you have that that green candle that
Yeah, that
engulfing the body of this, right? So if say you saw something like that, that will make that trade a little bit, more like more confident for you to take, right?
yeah.
And again, something again that we trade, you call it Monday's range. Say this is your high of that candle, and this is your low. And yes, this low has been taken, so potentially the height of this will be taken as well. So say you're entering a trade around here, maybe after engulfing candle, you don't know where your engulfing will be. So this is where you're measuring your risk reward. You're trying to lose just this small amount down here, but you're trying to target at least the high of this, right? So doesn't you don't really know how many candles you're going to use. Maybe your Monday range play only on this one, not this one, right? You still have a high risk reward ratio after a closure of this. If you want to play a Monday's range, like I said, when we get there, we'll show you guys, because again, like I said, a Monday's range is something happening like this. This is your high here, and this is your low. Now you have this low taken out. This low is higher than this one, and the price has come back in here. After a close, you enter now a long position, trying to stop down there, and you're targeting here. I assure you that's at least a 1.5 risk reward ratio to enter a price here and target this high and this low. It's at least, if not two, a 1.5 risk reward ratio. Now, a lot of different stuff, position sizing and other stuff, when we'll teach you guys in the future, you try to see that, okay, more of this stuff makes sense. You don't really need the whole market to move a day for you to make money. You just need to look for some range and trade it, and look for identify some stuff that you love, or some stuff that you think is always good for you, and you trade it. It's a whole bunch of stuff. You just need to choose your own. And again, when I mean choose your own, sometimes people confuse that I mean that you only have to trade this particular type of stuff. No, when I mean choose your own, it's like you see a trade, right? You see a chart, and maybe because like maybe let's say 10 different setups, 10 different strategies. Inside those 10 different strategies, you see a chart, you see at least 3 of those strategies happening in that chart. That becomes a good trade, a more better trade than just one strategy in that chart. You know at least 10 trading strategy, and then you open your chart, you're seeing at least 3 of those stuff happening in front of you. It gives you the high probability to enter that trade more than somebody that is just using one. So yes,
Makes a lot of
risk reward
sense.
ratio happen with other stuff.
Makes a lot of sense. So would you say it's better to know like 5 or 4 strategies rather than just knowing one? Because I hear sometimes people are like, just get one strategy and focus with that. But yeah, that is good too. But just knowing other strategies, so it's easy to identify them on the chart when you see them. It's better,
Yes.
right?
Yes. Say again, like I was saying, if I wanted to trade just Monday's range, right? I love Monday's range, right? I want to trade Monday's range, or a sweep and a reclaim, right? And just because I know that the hammer exists, that's already a strategy as well on its own. Just because I know that 3 stars in the south exist, that's a strategy on its own. But what am I trading here? What am I good at? Monday's range. So because this has happened, these other 2 strategies are here, my trade on Monday's range becomes good, because okay, I'm assuming that this is the high of my range and this is the low of my range. This low has been taken and reclaimed. Now I'm expecting the high to be taken as well. But just because I'm seeing these 3 red candles here, and they have diminishing return in the body, the size of the body drastically decrease, and you're also having your small hammer there, it will give me more confidence now to take my trade there, that my Monday's range trade there, and target the high of my and target my Monday's high, and stop below that high. There's also something called 3 drives, right? There's something called 3 drives that, okay, after this low and you get taken here, the next candle that forms, maybe the low is higher than this one, you trade that and stop below that, and also target the next, depend on what your supply area has been here, you target these areas and these areas. So it's a lot of those stuff. When we get there, we'll teach you guys, and you guys will get to understand when to apply some of this stuff together. But ideally, knowing different stuff is good, but don't try to use them all together, or try to use them all together at once. But when you want to trade something and you're seeing some stuff there, some of those setups there is good, but it's not like today you're trading Monday's range, tomorrow you're trading double top, the next one you're trading a head and shoulder, right? You have to see what works for you best. Does Monday's range work for you best? Does head and shoulder work for you best? If head and shoulder work for you best, and then constantly identify charts that have head and shoulder. And then these are the tips. You look whether inside that head and shoulder there's a Monday's range, there's a hammer, there is there is other stuff there, but your trading strategy is is a head and shoulder. But try to see if there are some other stuff that make the trade more valuable, that make the trade the confidence, that boosts your confidence in the trade. It's just simple as that. It's not like you shouldn't learn a lot of different strategy. No, try to know different stuff and know when to use them. But what I think people try to say is don't switch up a lot. Like if you're using Monday's range, use it at least 10 times to see how many times the average give you. Remember, I told you guys to be profitable in a trade or to be a profitable trader, you don't really even need a 50% win rate. You don't need to win up to 50 times. You need just 35% win rate over 100 to make money. Now, with other stuff added together and discipline and other stuff, you'll be able to make money with winning just 35% out of 100 trades. Now, if you're switching today, you use double bottom, tomorrow you use this, you will never know your average, you will never know what strategy you're using. You really never know. Like sometimes, even it happens to me sometimes. Sometimes maybe I will have some small money in a certain account, and then because I have a bad execution or I have a bad sizing, and then I'm seeing my Monday's range, I get stopped out the first time. There's money wiped out of that account. I cannot trade again my Monday's range, but it's playing. It's still playing. Just because I got stopped out the first time doesn't mean that I should change my entire strategy. It's still playing. I need to take it at least a certain number of times to be like, okay, maybe I take it continuously 5 times if and then maybe there's something wrong, there's something that I'm not doing. But switching up a lot is not good. But keep doing it and practicing it and getting an average is what makes you different from a lot of different people. We clear with that?
Yeah, for sure, for sure. Thank you.
Do we have any other question? Let me get back to this and see. So
Can you take it back? Can you take this this nature candle again?
say that one more time.
Can you take it once again, even it is from just to rush up?
What do you mean take it up again? I don't fully understand your question.
To explain this last candle.
Let me get to the chat and probably don't know what you were talking about. So
Yeah,
which of the candle you talking
the
about?
neutral.
Oh, okay.
Yeah.
Yes, I mean, we already did do that, but let me just explain it one more time. Okay, 1 second. Hold on. Stop sharing. Yeah, like I explained to you guys from last class, these are neutral candles, the doji candles, and the pure meaning or the basic meaning is just that the market is not moving to a particular direction. The market is cooling off. It's not making any decision yet. It's gearing up for a distribution or accumulation. So yes, neutral candle like this one, like this doji candle, it open and close almost or are the same. So it open and it close at almost the same price, or most of the time the same price. So it will make a wick up, make a wick down, but it close almost where it opened at. So when you start identifying those type of candles, you know that okay, we are having a period of consolidation. Like I say, consolidation being when price is just moving in a, a horizontal line with no movement to the side at all. So say you see a candle like this, that's your high, that's your low. Uh, there's probability that the next 10 candle don't go above this high or below this low. So when you start seeing some type of candles above here, like real candles above here, mean that the market has taken its decision. If you start seeing candles below here, the market has taken its decision. So long as it's like this, just wait until the market take out this or this. So yes, these are just Doji candles, not really a lot about it. You can find them after a trend, or sometime you can also find them towards the end of trends. Sometime when a trend goes and end, most of the time it doesn't just get a V recover, or it doesn't get a sharp rejection. So sometimes when the market goes and it bottom, it makes something like this, take a little bit of time for accumulation, for people to accumulate before the market goes up. Or sometimes you see this the top of a trend, when you, after upward movement, cooling off a little bit, trying to give people a little bit of time before massive selling off, before taking a direction or continuing to the upside. But most of the time you see this during the process in the intermediate area, or just market is not moving at all in a choppy market, where the market goes up, fake people, come down, fake people, and nobody really make money at all. It's really difficult to trade those type of market. So when you identify this, the best thing to do is not to hold a long position, a position for long. The best thing to do is try to buy towards the bottom of this